Hello friends. Due to a small medical issue, I am resorting to a voiceover instead of a usual video. Remain assured, the quality of the output and the work and research will not change. So last week, we spoke about how banks could basically drag the markets down further. And the worst was clearly not over. The markets did not disappoint. And coming up on your screen is the market roundup window, which tells us that the fall was led by the broader base Nifty, whereas the banking index brought up the rear. The US dollar index fell marginally, and that was ideally supposed to be a bullish trigger for emerging markets, including India, but unfortunately that did not work out. And that tells you the underlying nervousness in the sentiments. And a weak US dollar index boosted silver, but it did not boost gold as much as it should have. I have been telling you that I'm bullish on bullion, and I still think gold and silver are good long-term holds. Natural gas prices fell, whereas crude oil rose on a weak dollar, and this is something that might continue, the disparity between the two trends in gas and oil futures. More on that on our free Telegram channel. The US dollar index fell, which is the dollar eased against the Indian rupee, and that should have also been a bullish trigger, but it wasn't, so the market remained nervous. The 10-year benchmark bond yield rose 1 basis point, which means bond prices fell very slightly. The NSE market capitalization fell 1.10%, which means the selling was rather broader based. And the MWPL barely managed to rise because there is an expiry lurking up ahead, and beside the coming week is shorter by one trading session due to Ram Navami. The US market indices were up on a week-on-week basis, and that basically gave us some amount of tailwinds. Coming to the market-wide position limits, what you are seeing is that the MWPL has peaked at 29.81 against 32.42 in the previous month, and it has been the lowest in the last 20 weeks in question in the chart. That tells you that retail risk appetite has really contracted. People are not carrying over their positions, both long or short. That is a minor red flag. Coming to the stock and index futures turnovers, what you are seeing is stock futures turnover has actually risen, whereas the index futures turnover has fallen. Now, the fact that stock futures turnover has risen in a week when there was a decline in the overall market, it tells me, as I wrote in my Live Mint column, that declines in prices seem to be well oiled and well greased, which means the falls are likely to be a lot more easier and quicker as compared to the rallies. The fact that index futures turnover was lower tells you that indices being less volatile, traders were in risk-on mode where selling is concerned. They focused more on individual stock futures. Now, coming to the NSE advanced decline ratio. There was a mild uptick to 0.83 compared to 0.71 in the week prior. But do note that it still remains below 1, which is a bare minimum for a bull market to sustain with rising prices. So the prices were also in the negative, and the advanced decline ratio was also below 1. That tells you that intraday or one Marshmallow traders also lacked the risk appetite. Coming to the basis, which is the premium or discount prevalent in the futures against spot, the basis contracted on both the indices. Part of the reason, of course, is the lurking expiry of the March derivative series. But if the basis was to invert, which means if the futures are to trade below the spot market in the coming week, that could basically indicate that short sellers are coming out with daggers drawn. And that is something, my friends, we need to watch out for. I'll, of course, keep posting this on my social media account, with the Telegram channel being at the forefront of all our research reports. Now for our in-house exclusive indicator, the impetus, which you have been enjoying and trusting over 2 years now. What you are seeing is that the impetus on both the indices fell rather sharply, which means the selling last week was accompanied not by as much force as a full-fledged bear market would have been. Now, this is something that I have been writing in my Live Mint column and also on my social media accounts, that year ends are typically a time when institutional players come out and boost the NAVs of their schemes by buying equity, which is why the selling is not really fearsome. We need to watch the impetus in the coming days. Now, friends, the LWTD, another exclusive in-house indicator of ours, which you won't get on the public domain, and the LWTD saw a second consecutive week of staying below zero. That means on declines. Buying support, either fresh buying or short covering, is likely to be mild. Now, part of the reason, of course, is that we are looking at a short week, number one. Number two, it's March ending, when traders are busy balancing their books of accounts and planning their taxes, etc. So, buying support may not really be coming in wholesale. Let's also not forget the overhang of the prevalent global banking crisis, which I have been writing about in great deal detail on our free Telegram channel. Do take the effort of joining our free Telegram channel, where I put in a lot of work. Friends, the in-house indicators done, I now come to the bond market, which saw a 1 basis point reduction in the Indian 10-year benchmark yields. Now, that basically tells you that bond yields are not really running away anywhere. And I told you that I would be watching the 7.46 level on the upside and 7.18 level on the downside. We are neither here nor there, so we continue to wait and watch. And the bond market is likely to see some amount of volatility in the coming days due to the tax treatment that has been amended in the budget bill which has been passed recently, where your debt funds are now subject to short-term capital gains. Should we continue to ladder? I think yes, we will continue to ladder. And like I promised you on my free Telegram channel, there are some fresh windows of opportunities opening in the fixed income segment, which I will be updating since they open on the 1st of April, which is the new financial year in India. And you should wait up and buckle up for these updates that I will be posting on our free Telegram channel. Friends, the bond market done. I now come to the Bank Nifty, which lost 0.51%. And it fell on 3 out of 5 trading sessions last week. As you can see on the daily chart on your screen, the price remains below a month-long moving average, and the moving average itself is sloping downwards. So the short-term outlook also remains nervous, and the price remains at the support of 38,759, which was the swing high made in April of 2022. And what we would ideally like to see is the price moving above the moving average and heading towards or above the 41,840 levels before we can venture out a buy. Till such time, all fresh long positions are likely to meet with distress. Moving on to the weekly chart, the price has closed below the 25-week moving average, which is a 6-month-long holding on cost of an average bull, for the 3rd week in a row. That tells you that the medium-term outlook is also weak. The average itself has started pointing downwards. That tells you that the pressure on the bank Nifty has started to escalate. Here again, what we saw is a long-legged doji, which means there was indecision with a slight weak bias in the bull and bear camps. What we would what we would want to see is whether the price breaches the 38,759 level on a sustained closing basis. If it does, bears will have an upper hand. Bulls, of course, will have to pull the bank Nifty above 41,840 to come back into the driver's seat. Now, in the week before last, the bank Nifty was number 2 on our in-house statistical beta list, which we maintain of the most volatile counters. The bank Nifty slipped 4 notches to close at number 6, not because the volatility of the bank Nifty fell. Of course, the range was slightly smaller, but comparatively, individual stock futures saw a big spike in volatility due to the sell-off. And that does not reduce the challenge for an average retail trader. Last week, I advocated a range between 41,125 on the upside and 38,075 on the downside, which held perfectly well. In the coming week, I expect a range between 40,900 on the upside and 37,900 on the downside. I continue to advocate trading light. Don't forget, this coming week is shorter by 1 trading session. Friends, the bank Nifty done. I now come to the Nifty 50, which fell 0.91%, and it fell like the bank Nifty on 3 out of 5 trading sessions. The price remains entrenched below a month-long moving average, which itself is sloping downwards, which tells you that the short-term outlook remains under pressure. The price is still deriving support at 16,793 level, which is a swing high made in June 2022, and that will be a last mile support that we will watch for on a sustained closing basis for the Nifty spot. Moving on to the weekly chart, the price has closed below its 25-week exponential moving average, which is a 6-month long holding on cost. For the 5th consecutive week in a row, the average itself is sloping downwards. That tells me that the outlook is clearly under pressure. This is not a mean reversion decline, but probably the beginning of a decline, a fresh decline. That will be confirmed if the Nifty starts to trade on a closing basis sustainably below the 16,793 levels. Now, in the week before last, this index was at number 5 on our in-house statistical beta list of most volatile counters. It has slipped 14 notches to number 19. Here again, it is not because the volatility of this index has fallen, but because, relatively speaking, individual stock futures volatility has spiked. So the challenge still remains. Last week, I advocated a range between 17,600 on the upside and 16,600 on the downside, which held perfectly well. In the coming week, I expect a range between 17,425 on the upside and 16,450 on the downside. Continue to trade light, my friends, and exercise due diligence. Do remember, volatility can spike, and avoid trading counters where the bid and offer spreads are more than 6 ticks or higher wide. That is where your maximum risk element remains. Friends, I now come to the last bit of statistical analysis of the retail risk appetite and which way the cookie crumbled. What you are seeing on the daily chart of a 20-day look-back period is that the sky blue line representing stock futures turnover has very simply hit a period high. Now, I have recorded a video about what happens and what indications we get when traders switch from index futures and options to stock futures and options. Do take a look at that. It's in the description and in the pinned comment below. So retail traders have basically pressed sales and participated in stock futures sales. Now the olive green line, which indicates the stock futures turnover, has also hit a similar high. That tells you that declines were well greased and well oiled, and it found participation from two Marshmallow traders. Now for index futures turnover, that remained more or less sideways because like I said, retail traders were more focused on individual stocks rather than index futures. Their risk appetite grew. Unfortunately, the risk appetite grew on the short side. Now coming to the index options turnover, which happens to be the safest out of the four segments of index futures and options, stock futures and options. Index options is the relatively the safest instrument. There, the turnover actually fell the sharpest because traders were busy seeking opportunities on the short sell side in individual stocks. That tells you that the sell-off and the decline is well oiled and well greased. Now, friends, for what would I do in the coming week? I will continue to bet on theta decay on interest rate sensitives, and I will continue to seek selling opportunities in the commodity space in energy at select price points, not just go any short at any price points I feel like. And I will expand my scope of betting on theta decay, especially on those counters where MWPL or market-wide position limits still remain concentrated in spite of the fact that prices have fallen. That basically tells me from a behavioral finance perspective that hope is still making an average retail guy hold on to his long positions. As and when his patience breaks, there will be a crowded exit in terms of rapid price declines in those counters. And of course, like I said, I would also wait for a fat tail hedge risk in the currency space. I haven't still initiated that trade yet, and I'm waiting for the right price point, but it's still not happened. I would continue to ladder fixed income instruments, and I would raise allocations to fixed income as and when the new window of opportunity opens on 1st April, which I promise to update on my free Telegram channel. Friends, now I come to the most popular segment of this video for the statistically inclined traders, wherein I give you 5 stocks which have gained the most amount of impetus on Friday. So you take a small exposure and wait for large price moves on Monday, and 5 stocks which have lost the most amount of impetus on Friday, where you take big exposure and wait for small price moves. This is for scalpers. The impetus gainers list is led by Gas Authority of India, GAIL, Shriram Transport Finance, NMDC, Torrent Power, NALCO. Impetus losers list is led by TVS Motors, Balakrishna Industries, Polycab, Mahindra & Mahindra, and HDFC Limited. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, please do let me know how our videos are helping you trade better in the markets and how our Telegram channel is adding value to your experience as a trader. Also, please help me reach out to a wider audience by sharing my video with like-minded traders, family and friends, and smart players like yourselves. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very profitable week ahead.